Thanks everyone for joining us today. Here at DIS, we are very excited to be joined with George Russell, co-founder of the Machinery Advisors Consortium and a columnist with the Farm Equipment magazine. He has been in the ag and construction equipment industries for over 45 years and brings lots of expertise and best practices to the table. Today, he'll share with you all how to propel your dealership from good to great by tracking the key metrics and actions to build a culture of performance. Before I hand over the floor to George, we have a few notes to share. Kindly save all of your questions until the end of the webinar and direct them to the Q&A box, and we'll address them then. A poll question will come up during the presentation, and we highly encourage you to participate. A recording of this webinar will also be made available and emailed to you by tomorrow to share with your team or rewatch on your own time. And lastly, a survey will pop up at the end of the webinar. Please do fill it out, as your feedback is very important to us. And now I'll welcome and pass it over to George. George?
Ola, thank you very much, and thank you for DIS for sponsoring this webinar. I'm excited to present this to the people on the webinar and the people that will record this. This is a distillation of my experience in the industry and working both with manufacturers and with dealers. And I'm looking forward to the feedback and reactions that people have from this that might provoke them to improve their behavior and go from good to great. And we'll explain what that means. As Ola said, I've been in the industry with both manufacturers and dealers for a long time, probably 24 years with manufacturers, IH, Case IH, CNH. Been working as a dealer and with dealers since 2007. I work in both ag and CE. My last job with a manufacturer was running the Case construction business in Europe. I write articles for Farm Equipment magazine, and many of you will know me from the Big Dealer Report that we started with Farm Equipment magazine in 2009 to understand the dynamics in the farm equipment industry that is happening with consolidation and how dealers can succeed in a very rapidly changing environment. And I started the Machinery Advisors Consortium in 2015. MAC, as we call it, offers training services for dealers and for OEMs to their dealers. We do coaching, including best practice performance dealer groups. It's the core of our business to stay close to dealers and what's happening in the marketplace. We deal with generational changes, such as family businesses. We do a lot of individual consulting around people, around the parameters and financials, and with the pace of mergers and acquisitions, we do a lot of business valuations and succession planning, and do webinars and speeches such as this and serve as expert witness as well. The MAC team you'll see here is growing. We've added 2 people in the last 6 weeks. Russ Green in the middle and Dave Dell in Colorado have joined. We are now 13 people. We span the generations, going anywhere from 40 to near 80. So the generational changes that are happening, we acknowledge and are helping dealers manage through that. And part of the intent of this webinar is to help people that may be early in their careers to understand some of the things that some of us that have been in the industry a while might have learned the hard way, or with insights from mentors that would help you early in your career to be successful in our industry, which is an exciting industry to be in, agricultural in general, and with the technology and biology and mechanical technologies, it's fun to be in the farm equipment business. I say the MAC team because you'll see on the left we have an acronym here about trust, empathy, alignment, and motivation. This title of this webinar is about metrics. That's a bit about alignment, but it's also about alignment is also about vision. So I hope out of this that we will motivate you to look at your dealership a different way and how it can move from good to great. So that's part of the intent of this webinar, is to motivate you, provoke you in many cases to look at things a little bit differently. On this map, I'm in Vermont, the upper right-hand corner. Vermont is the second smallest state after Wyoming and is actually the most rural of states in the country, defined as percentage of the people not living in a city or a town. I'm a farm boy. We've had the same farm in our family for 8 generations. So it's been in my blood and my ancestors' blood for a long time in farming. I mentioned Vermont for 2 reasons. One is maple syrup. We're the largest producer of maple syrup. Stay tuned for that. But also, many don't realize that Vermont is the birthplace of John Deere. And we'll actually use this John Deere A tractor in this webinar as an analogy. This is, in fact, the first tractor, the actual first tractor that I drove when I was 5 years old. My older cousin helped me drive it because a 5-year-old with a hand clutch on the right-hand side, I didn't have to reach the pedals, I just had to reach the handle. But on the other side of that John Deere, which is called a Johnny Popper, is a flywheel. That flywheel is the analogy that we're going to be using. And this is called a Johnny Popper because it has only 2 cylinders. With only 2 cylinders, because of that flywheel, this tractor can have the torque and the power to go through the tough spots better than a tractor with 4 and 6 cylinders. And I've experienced that in the fields in comparison to that. So the key to this tractor, this John Deere Johnny Popper, is the flywheel. The flywheel analogy I first heard from Mike Lessiter, publisher of Farm Equipment Magazine, and he wrote a column about this book that I'm showing on the screen by Jim Collins called Turning the Flywheel: Why Some Companies Build Momentum and Others Don't. Jim Collins' first big book was called Good to Great, which he published in 2001. He studied over 1,400 companies over 40 years of their history, and only 11 of those went from good to great. And in his books, Good to Great, Built to Last, and several others, he takes through the point of disciplined people, disciplined thought, and disciplined action. We're not going to get into all of those today. What we're really going to talk about is the flywheel, which is his latest book. It's an easy read. It encapsulates all the other elements of his previous books that are useful to know. And the flywheel analogy that we'll use is the generation of momentum in a business that helps you build up and do that breakthrough. And as he identifies, helps to move from good to great. So the flywheel analogy is what we'll use. And when Mike published that article a couple of years ago, a couple of other dealers, a couple people in the dealership area, dealers themselves, did the same thing that I did. They said, how can we apply that good to great flywheel to a farm equipment dealership? I realize there's some construction and outdoor power and industrial dealers on the call as well. So they'll focus on farm equipment. This applies to other dealerships of other businesses as well. This good to great flywheel, you'll see that each of the arrows, each of the colors, think of that as a stroke on that Johnny Popper. That's an impetus to your business to propel it forward faster. One can start anywhere on this flywheel to explain how to move from good to great and build up the momentum. I like to start on the lower right-hand corner with the purple, leveraging the new to use cascade. As you get that right, that helps propel you to the next stroke or pop, which is invest to grow and generating high absorption. With that pop and that impetus, then you can have the money to invest and also the vision then to have a culture of performance that you need to build to attract and keep employees, and also with robust processes that allow you to capture and keep good long-term customers. With that performance culture, that mindset, you balance your dealership, you sell solutions, you sell all the things that your customer will want to and support them over the generations. With that approach to the business of a balanced dealership, you need to market to all of the segments of the business and have in your marketing relationships to ultimately consummate in sales that ability to maintain those relationships and build on them. So those are the 5 elements of the flywheel, but you'll also notice at the bottom, leveraging 2 other key things: leveraging leadership and leveraging technology. And we're going to cover each of these in the explanation of the good to great flywheel, and we'll use that analogy of the stroke of that Johnny Popper as we go through each of the elements. The title of this webinar is called, "Are You Tracking the Right Performance Metrics at Your Dealership?" What you manage, what you measure matters. At the highest level, in my experience, there are 2 high-level metrics for a dealership. Every business exists to sell to customers, and how you create customers and create repeat customers is a high-level metric. And we will talk about how to measure and repeat customers, but that's the highest level objective of any business and a farm equipment dealership. The second high-level metric is return on assets. In an asset-intensive business, how do you get the most return on the capital that you employ to run your business? So these are the highest level metrics to create a customer-centric culture. And both of these relate to customer centricity. Obviously, the left one does in terms of creating repeat customers, but if you have the robust processes within your dealership that achieve a high return on asset, I've seen you also have the robust processes that keep the customer satisfied and mean they'll come back to you. So they're related to that customer-centric culture. What are the key metrics? And again, you can start anywhere on this flywheel to talk about metrics. And we'll have 1, maybe, and 2 in a couple of cases of key metrics to walk through. And some of these will be provocative, and that's intentional. I want to stimulate your thoughts about different ways to measure your business that matter. And one of those, some of these are been around a long time, like absorption, but a couple are relatively new and I think have some meaning. And that is example of the first one on the lower right-hand corner, leveraging the new to used cascade. So we're going to actually start with a pop on leveraging the new to used cascade. So that's that first stroke. The verb here is leverage. Leverage the new to used cascade. All of us have mentors in our life and in our business. And one of my mentors helped me appreciate when I was moving to a regional sales manager position working with dealers, said to me, "Son, you think this is a new equipment business because you work for the manufacturer. Forget that. It's a used equipment business. And the sooner that you understand that, the better." And that was 25 years ago, and he's right. Used can make or break a dealer. That can be in terms of whether you have evaluated the trade-ins correctly. It's a part of your marketing mix to make sure that you're not just selling to and finding new buyers, but those second and third and fourth buyers. And because cash is king in our business, asset intensive, what you have in your used equipment can lock up cash that you might better use somewhere else in your dealership to help grow. So many of us have seen that dealers that have gone under because they got the used equipment business right. We've also seen dealerships that have been very successful because they are in the used equipment business. This doesn't mean that new equipment isn't important as well, but there's a balance with new and used. The other part of the new business or used business is the more equipment you have that you're maintaining a relationship with of either your brand or selling to other brands, you drive parts and service sales. And that's part of that connection between leveraging the new to used cascade into the next pop of investing to grow for high absorption. Let's talk about the washout as a metric. And first, let's have some definitions that will be helpful. In any business, there are a few number of customers that generate a lot of business. So think about your business and take your biggest customer and count down first biggest, second biggest, third biggest. When you get 40% of your business, those are A-level customers. They may represent only 2% of your customers. Then those are A-level customers. The B-level customers you count down to the next 30%. So now you've got 70% of the customers generate, in this chart, 10% of the business. In fact, in farm equipment in the US and Canada, in farming, it's not 70-10, it's actually 66-4. That's how highly concentrated farm sales are in North America. A few number of customers generate 70% or a significant portion of the business. And then there are a large number of customers that are C&D customers, but generate less part of the business. A simple rule of thumb that works in most areas of North America, except in my experience in the high plains or the prairies of Canada, are just simply to count the number of machines, engine-powered machines or big planters or drills that a farmer has when you go on to their place. When you get to 26, quick counting, you are on an A-level farm. B is 11 to 25 and so forth. So those are ways to categorize customers by size. We're setting this up for a couple reasons, but to illustrate what I mean by calling the new to use cascade. So typically what happens is the A-level customer buys new or near new equipment and often tends to roll that frequently. Then that new or near new equipment is traded in and resold as a used equipment to the first or second buyer, typically to the B-level customer. Then the trade again, that piece of machinery goes to the next level and to the C or D. And that's what I mean by the cascade of new to used, and that it was typically happen. Not always, but this is typically what happens in our business, that the new machines are bought by the A customers, and then B, C, and D will buy the used equipment. Again, not always, but it is typical. This sets then up the discussion about a metric about washout. I happen to use a DIS washout tree in our work with dealers and dealer performance groups and in training and in consulting. So the upper part of this slide actually shows a DIS report from a good dealer in the Northern Corn Belt. And you notice that this goes back to 2017. And I've taken the example at the bottom of what has happened. So in this case, the combine comes from the factory and it's delivered to the dealer and invoiced on the 5th of December. And the price of that combine was $255,000. 2 weeks later, that machine was prepped. It was a 2018 machine, so the next year it was sold for $266,000. The cost of goods sold was $255,000. The dealer took a trade worth $239,000 and a cash of $26,000. So that reduced their cash position, being in the hole, to they're only in the hole for $229,000. Because the dealer pre-sold the trade, only 4 days later, they delivered a 2017 machine to another customer. Their cash position, they took in $33,000, so they improved their cash position, actually lost money on the deal, but got better on their cash position. And then before the end of the year, traded in another machine and sold that, got a lot of cash and made some good money on that. And then the fourth and fifth sale, one in February, which made good money. And this dealer sent the last machine, the 2388, to an auction in August. Actually lost money on that auction. The washout analysis does several things. It helps you understand whether or not you truly make money on that new piece of equipment. In this case, the dealer made $20,000 or 2%. It also helps you to understand how much cash you have tied up and locked up in your trades. And it also then helps you motivate when sales reps to sell the used equipment. And in some cases, this type of washout analysis, the compensation program for a sales rep, is not until the machine is washed out. So we think washout is a very important factor in our business and should be used more. As far as creating repeat customers, the best practices in used equipment are to treat those used buyers like new, have a dedicated used marketing and a good CRM. And the faster you trade and go through the washout cycle, the number of trades, 3, 4, or 5, the faster you'll have turns and get your cash back out. Pre-selling is important, a good robust appraisal process, and early visibility within your dealership for trade-ins coming in. So that's where your CRM and your business system can help. Pop. We got another stroke. Invest to grow. High absorption. Absorption was created when the first pioneers in our business started setting up dealer networks. John Deere, Cyrus McCormick, J.I. Case, Larry later, Henry Ferguson, Daniel Massey. So absorption has been around a long time, and it's started out as a defensive measure for sustainability in the downturn, but it also helps create the capital to grow. Ola said that this is there's going to be a test, and here it is. Here's a set of numbers for a dealer that's selling 1,000 or 1,000,000 on the upper right-hand corner, broken out by whole goods, parts, and service. I've shown the cost of goods sold, the gross profit. The question is, and this is a test, put your answer in there. What is the absorption for this dealership? Calculate it and put the answer in the poll question. The first answer, I'm going to give a bottle of Vermont maple syrup to the person that answers correctly first. I'll also tell you that for those of you in construction equipment or that are in a rental business, that we don't show rental, but that's a can be a key part of absorption. I'll also tell you that there are different ways to calculate absorption. And so you may have a different answer, and if it's a different answer because you use a different methodology, I'll entertain some different answers. But please calculate that, and then Ola's going to pop back in with the first person to have the right answer.
So we had a few answers come in, but unfortunately none of them are right, and the poll is now closed. So
all right. So in the interest of time, I'm going to move on. The answer to this question, and I actually put it on the slide. If you look at the green divided into the red, that is the simplest way to calculate absorption. So the total parts and service margin divided into the total dealer expenses. So the right answer is 71%. I'm not surprised we didn't get the right answer, because as fundamental as absorption is in this business, I've never had a group of people, dealers, actually answer this in less than 1 minute. But it's important to understand what drives absorption, because it is so fundamental to the business. In the green, you're trying to maximize your revenue and margin. That means how you price and how productive you are. On the red side, you need to manage your expenses, your G&A and all that's allocated expenses to the dealership. And there's also mixed expenses related to your assets, your carrying costs for inventory in the service department and in your dealership, the work in progress. There's cash and money tied up in that has an expense. So these are the drivers of absorption, and the best practices are to do them both, or do all three of those. Let's talk about productivity. If I've shown this chart once, I've shown it 100 times. And that is, how do you get to gross profit in the service department? Assume you have 5 technicians and you pay the customer, you charge them $70, 1,768 hours. The math says your service revenue is $618,000. Your cost of goods sold, those same 5 technicians, you pay them $20 an hour in this case. You pay them for a full 52 weeks a year at 40 hours at $20.80. So the cost of goods sold is $208,000. And the 2 key numbers here, because we try to simplify it, you need to look at the revenue multiple, which should be north of 3.5, and the hours need to be north of 85%. If both of those are true, then mathematically you're going to achieve the target KPI of 65 to 70% gross profit in the service department. The first number, the revenue multiple, that varies depending on where you are in the country. Unfortunately, for those in Canada, I haven't found a comparable chart for Canada, but this shows you the highest and lowest pay for farm equipment technicians. It ranges from $14 an hour to $35 an hour at the highest. So almost a 2-to-1 difference depending on where you are in the country. These are reported off of your W-2s. So where you are, as you know, depends on what you pay your technicians and what that 3.5 ratio is. For those of you in the construction and industrial areas, here's the same picture, which is a little different change. You see a lot of bluer areas around the oil patch and around cities. The 2080, middle of this chart, hours paid. If you're paying a technician for a full year, the application ratio should be of productive hours that are charged on a work order are the 1768. When you lay a work order in front of a technician, they should bill at least that. That's the definition of efficiency. The difference between 1768 and the 28 is at the bottom, non-productive hours, some of which is allowed and some of which is expense time, like training or rework. So these numbers, efficiency and application, help get you there. The first number on the left, 1768 into 2080, if that's not right, if there's an issue, that's on the service manager. As the service manager got enough business to lay productive work orders in front of a technician. That's application. Efficiency is hours billed versus hours applied. And again, the objective is 100%. You have some technicians that exceed that. So that gets then the 85%. So productivity and service helps drive absorption. Absorption is the defensive measure. It's also an offensive measure to create capital to grow. We live in our industry is an asset-intensive business, and the rule of thumb is 10-to-1 capital to sales. Capital meaning net worth or owner's equity. So if I get $2 million worth of capital, I can adequately support from capital $20 million in sales. If I'm a $20 million dealer, my objective ought to be 5%, at minimum 5% return on sales. We're using cowboy math here. That's going to drop $1 million pre-tax to the bottom line. Assume I'm paying 40% state and local tax. That's going to vary. So that takes me down to $600,000 if I keep it in the business. If I keep it in the business, that now adds $600,000 to the $2 million I started with at the beginning of the year. With my $2.6 million and the same 10-to-1 sales to capital, I can now adequately support from a capital side $26 million worth of sales, or a 30% growth. That's on the capital side. That may not, there may be some other issues related to people, but the absorption drives high return on sales because service and parts should generate the highest gross profit dollars for the dealership. So better absorption generates high return on sales, and from that then generates the capital to grow. Those of you that are financially oriented, the assumptions behind that 10-to-1 are on the right-hand side of this in terms of how you get to that. Be glad to answer that if anyone wants to get into this deeper. So, best practices in absorption. Creating repeat customers is about robust processes. High productivity for your techs and all your people, delivering best customer service, and the best practice, what separates the good from the great, is expense control. In my experience, most people don't, dealerships don't appreciate how important it is to control expenses. That leads then to a disciplined performance culture. If you want more information about how to set up budgets to manage expenses and drive that into your dealership, go to the MAC site and look under our articles and speeches where we've laid out in various categories, benchmarks and budgeting. We've also got these good to great series, so you can easily pull these off our site. Our site's number is, our URL is in the lower right-hand corner if you don't have it handy. It ends in ORG. Performance culture in farming. The farming business today is highly productive, performs well because of the integration of 3 different technologies. Mechanical technology related to biological technology because of growing crops and raising livestock. And now we've got the integration of information technology. So at that intersection is where the best performing farmers are today. Same performance culture in your dealership, the integration of the parameters, what are the metrics, the things we're talking about today, the robust processes, and the people that help manage all that. As far as metrics, at MAC, we don't aim for average, we aim at well above average. For us, peak performance is the 75th quartile or higher, and that's where we set the KPIs. That is high performance. And so that's where the target says, because no one wants to be average or median, the target is to set that higher. And that leads to the next spoke on the flywheel is build performance culture. And that has 2 elements. Building a performance culture related to being an employer of choice or about process. This is about the employer. This comes back to expectations around alignment, around motivation, around vision, and helping to connect with customers through empathy. All of those things that we lay out in the acronym TEAM. On the processes, there are some vital processes in each department. In service, the fundamental process is how you manage work orders to get the customer's expectations and manage all the way through the billing cycle and collections with a work order and with less WIP. For parts, the key thing is my definition of stock and non-stock parts. If I've got 100% objective for stocking parts, I'd have that part when the customer comes in. If it's a non-stocking part, I don't need it, I shouldn't have it. That helps my turns. In whole goods, the key process is sales activity, which we'll talk about as one of the later spokes, and then expense control we just talked about. The metric, and these are some new metrics that you may not be exposed to, but employee retention. Because of people is so important to your business, are you keeping the right employees? And are you measuring that and noting how, if you have an issue with employee turnover? We're going to focus on the customer side of the business, and we're actually going to use data mining reports that you can get out of your business system to help find the opportunities to connect with your customers. These are data from a 5-store complex with 8,000 customers. What I've highlighted on the right-hand side are examples where if you rank the customers number 1 down to 8,020, you can see that that customer, the second line, they are high in equipment sales. They are very low in their parts ranking, which means they're probably buying parts from somebody else. Similar down with that one with service. This is high in service, whole goods and parts, but low in service. Are they doing their own work, or is the work being done by a shade tree or someone else? The next one down, low in both parts and service. Those ones at the bottom, those need to have some investigation. So mining the data of your customers helps you connect with them and helps to understand what things might be doing in terms of your opportunities and losing customers. We have proposed this last year in the articles we write. A couple of the bills in MAC Advisors, Bill Mays and Bill Hoig, wrote a couple of articles about this. And one of them defined a way to define what we think is an important metric, not customer satisfaction, but customer retention using your own data. And in this example, you'd use the same type of data mining to look at your current customers, how many new customers you have, and then what percent of the customers you have are still buying a year later from you. In this case, this example, that metric would be 84% retention. Go to our site, look at that article. We think the customer retention metric is a good way to look at your business, and we challenge you to do that because that is the highest level metric, is creating repeat customers. And what you measure matters. This matters. Are you retaining customers? Here's a way to measure it. Pop, actually 2 pops. Balanced dealership, sell solutions. The key metric here is sales mix, both for the department and for the customers. And then this leads then to marketing relationship to all segments. You'll hear, we'll talk about solution selling and everybody selling and everybody serves and listening to customers. In a balanced dealership by department, on the lower left, first of all, you'll see the key metrics in the middle of that pyramid. And notice that we don't say the sales department, the parts department, and the service department. Every department sells in a balanced dealership. So it's whole goods sales, parts sales, and service sales. The link between service sales and whole goods sales is on the lower left, because the biggest customer of service is the whole goods department to set up machines and get them delivered. If you're good in service, that helps sell whole goods. If you're poor in service, that's the quickest way to lose a customer. On the whole goods side, the whole goods to parts, the more machines you sell, the more parts sales you have. If you're good at parts, you have the parts when you need it, that helps sell whole goods. But poor availability, like service, loses customers. And on the parts to service side, the biggest customer of parts is the service department. And how well the parts department feeds the techs helps shop productivity, like we talked about earlier in the gross profit for service. And part technicians are part salespeople when they put parts on a machine. So sales mix is the metric. In this chart, you can see at the bottom, this is the history of a typical dealer in our dealership from EDA reports from 2007 to 2019. The bars are the total dealer volume, and you can see there's some low years. It popped up in 2013 and 14. It went down in 2019 and back up in 2019. The line at the top is the contribution, what percentage parts and service are as a percent of the total dealership. That will vary as a percent of the total dealership depending on where you are in the cycle. And we like to see a total of 30%, but it will vary. Look at the bottom bars, that's service. Throughout those cycles, service stays relatively the same and grows. The same with parts, which is in red. That's the driver of absorption, are those service and parts sales. So sales mix, I've now got a sample dealership of 100, and what we like to see is service north of 10, parts north of 20 for a total of 30. Just at a very high level math, you look at the margin, you look at the expenses, and the rule of thumb, it's surprising how well it works as long as we've been in the business. If you don't have any other means, allocate your expenses a third, and a third, and you can see that service and parts and whole goods generate about the same net profit. So look at that. The more your higher mix of service and parts, the more profitable your dealership should be. Manage your expenses. Marketing relationships. This is the next pop. You've got on the right-hand side, marketing relationship with coverage and penetration. On the left side with that box, you've got the various elements of the marketing cycle. Promotion and branding, and then direct selling. And how you employ your market resources will depend on the type of customers. And going back to this new to used cascade, with those A and B customers, you can afford to send a sales rep on missions to seek those customers. On the C and D customers, where there's so many, you need to employ a different marketing process, which is at the top here in promotion and branding. And when you create interest, then you can do the direct selling of discovery, consideration, and buying. So the segmentation is important to how you employ your marketing relationships, but you need to have a marketing relationship with the C&D customers for the purposes of the new and used business. The metrics in this area for direct selling are coverage and penetration. Participation is of the sales that are sold in your trade area, how many are you in on? How many quotes do you have? The close rates of the quotes that you have, how many do you actually sell and get a signature? The result of those is market share. There are two ways to approach this. If you are in on 40% of your deals and your close rate is 75%, mathematically you'll get 30%. Contrast that with the other end, you're in on a lot of deals, but your close rate is lower, you still get to 30%. The top one is typical of an experienced sales rep. The bottom one is the experience of a new sales rep that's out there with fresh set of legs, but they may not have the ability to close. So the best thing to do if you don't know participation is calculate your close rate, use your business system to know that. You can then back into participation rate. So both of those are important. Two final pops. Culture. So goes the leader, so goes the culture, so goes the culture, so goes the company. Creating a customer-centric culture that creates repeat customers and high return on assets means looking at all of these elements of the good to great flywheel and setting that performance expectation. Leveraging technology. And we write a lot about this. Technology is a force multiplier inside your dealership, for your customers, and for your marketing. And the technology is changing fast. So we're back to these metrics to remind ourselves of how these all work together. And the faster this spins, the faster you'll move from good to great. A call to action. Many dealers are sales focused. They call it the sales department. The parts and service business just supports the quote sales department. The balanced dealership approach, we just talked about, you're selling solutions. Every department sells, service pays, and you're integrating all the 3 Ps. The dealer of the future, what I call the second machine age dealer, is using technology to connect, to collaborate, and because the technology is changing, they are flexible to that, so they have a sustainable, good to great dealership. If you want to learn more, because we've covered a lot of this fast, go to the MAC website, look at the articles. We've grouped them so you can look at the good to great flywheel and then this year's theme about creating a customer-centric culture. Look at, and if you want, get this book, the Turning the Flywheel. You'll learn a lot from doing that. Thank you for your time and attention to this. And Ola, we're going to open this up for questions.
Thank you so much, George, for the great presentation. It was very informative, and I hope everyone enjoyed it as well. If we can direct the questions to the Q&A box, George will be more than happy to address them. So we've got a question about the slideshow being available. So a recording of this webinar will be made available by tomorrow, and you can check it out. If you just need the slides on their own, feel free to send a note to sales@discorp.com, and we'll make sure to get those to you.
Ola, I see that Jody Craven said she couldn't find where to find the answer. Jody, if you have got the right answer of 71, let Ola know your address, and you can put some maple syrup on your pancakes.
All right, we got a comment saying no questions. Thanks for the great presentation. And then another one coming up. Let's see.
So Matthew Foster is asking, we used 5% return on sales. How representative is that? The actual number depends on your sales mix. If you have a higher sales mix of parts and service, that return may be higher than that. The best dealers in our industry can exceed that. Also, in reality, a lot of dealers, when they make good money, we often have to unpack and find out if they're where some of their expenses are, and because dealers often manage their income for the tax man, and so we often have to figure out from an operating standpoint where the expenses are. But 5% is certainly achievable. It's aggressive but achievable, but the best performing dealers can achieve that.
Thanks, George. We have a question that came through privately as well from Kyle. He's asking, that data mine looked really useful. Any chance it's publicly available for download? Or
so that would go back to your business system supplier in terms of how you can do that. And I believe, Ola, that in DIS, you actually call that tool data mining in DIS, right?
Correct. So if you are a DIS customer, you can definitely reach out to your account representative and they can help you with that. If you're not a DIS customer, reach out to your DMS provider, or we'll be more than happy to give you more and show you more about what DIS can offer. Let's see if we've got other questions. We have a question from Todd. He's asking, where do I find the washout tree in DIS? Under what heading? So Todd, I'll reach out to you after this webinar and put you in with the correct person to help you with that.
Yeah, for those of you that are in our industry, the biggest proponent of washout analysis is a gentleman named Casey Seymour. And he writes often on this article. He and I have been on a panelist together. He has a podcast called Moving Iron, and which is all about moving iron. And if you can learn a lot by signing up for Casey's podcast on that. It's also something we teach in our sales management courses and in our work with our performance dealer groups. We walk dealers through that and actually have them bring their washout analysis. Oftentimes dealers don't even know they have it, and we walk them through that and on how to use that. It is something I think it's important for us to understand for the reasons we talked about here.
Another question for you, George, from Devin. What should a dealer shoot for repairs and maintenance as percentage of revenue? That is a service department R&M and isn't billed to a customer.
So if the question is what percentage of your business should be in the service department or repairs and maintenance, if that's the question, Devin, that's that 10% or more of the business. Service as a percent of the total business. But maybe I didn't understand your question. So if I didn't, Devin, ask it again a different way.
All right. Let's see. I think we have another question. Nope. Devin replied, that's helpful. Thanks. So I think you addressed his question. Thank you, George.
Yeah.
If anybody has any additional questions, please feel free to ask them now. All right, so it looks like everyone has got a lot to think about and take in. Thanks so much again, George, for the great presentation. I hope everyone enjoyed it and got something out of it. Again, once you exit this webinar, there's a survey that will pop up. Please do take some time to respond to it, and look out in your email for the recorded webinar tomorrow. And on that note, thanks again so much, everyone. Have a wonderful day. Thanks, George.
Thank you, Ola. Thank you, DIS, and thank you, everyone, for listening. If we can help, you've got the contact information on our screen. We'd love to talk to you.
Thank you.